Netflix stock, ticker symbol NFLX, just reported earnings after the bell, and it is down 1.86%. It was up nearly 2% today, so net, the stock was flat. But we're going to talk about Netflix stock. Why was it down, and is it a buy right now? Let's dive in. But before we do that, if you could please go ahead, like and subscribe. It really, really helps me out. Now, you guys all know what Netflix already does. I don't need to explain it to you. They're just a subscription-based streaming service that provides access to TV shows, movies, documentaries, original content. They do a couple of ancillary stuff on the side, but largely they're just a subscription service. That's their one business model, and they have various pricing tiers that you can pay for, and then they also show ads on their platform as well. The platform has vast reach, and the earnings was actually really, really good. Revenue continues to grow about 14%. Earnings per share grew 47%, so a ton of operating leverage, both beating the analyst expectations. In fact, this was actually a stellar quarter when you look at it in aggregate. Diving into the details more, you can see here, gross margins expanded, net income margins expanded, free cash flow margins expanded from the same quarter last year. As a result, net income was up a lot from 2.1 billion to 3.1 billion. Huge moves. Free cash flow as well, 1.2 to 2.2 billion dollars. Absolutely insane. A stellar quarter, and the company's balance sheet looking really robust. $14 billion in debt, $8.3 billion in cash. You can't really fault the balance sheet right here. A little bit too much debt for my liking, but they do have a cash position that's pretty sound. So revenues grew, just under 16%. Cost of revenue grew 4.6%. And ultimately, that's how you get that operating leverage built into the stock. And that's how you see net income growing 45% and earnings per share growing 47%. Revenue across the segments growing very, very linearly. We're seeing a bit more growth in stuff like Asia Pacific, Latin America, but Europe, as well as the North America segment growing as well, but not quite as fast. And that's completely normal because, this segment does make up about half of its revenue anyway. And North America and Asia make up close to probably 80% of total revenue, is something like that. The guide for Netflix was also really, really good. In fact, they guided for sequential growth as well as year-over-year growth in Q3 compared to Q2. They're looking for revenue to grow as well on the quarter and year over year, as well as operating income. Operating margins to decrease a little bit compared to the second quarter to 31.5%, but significantly higher from the same quarter last year. And then you're looking at earnings per share of $6.87 compared to $4.88 in Q2. So, they're guiding for continued growth. They're going to see this momentum continue. And that's, to be honest, what you should expect for an asset-light business model like Netflix. Now, diving into the shareholder letter, there's a couple of things I want to outline. The guidance they gave wasn't just a guide that the market was expecting. It was actually a raise from their previous guidance. They said for 2025, we are increasing our revenue forecast to 44.8 to 45.2 billion from 43.5 to 44.5 billion previously. This represents 15 to 16% year-over-year growth or 16 to 17% growth on an FX neutral basis. The majority of the increase in our revenue forecast reflects the recent depreciation of the US dollar versus most other currencies, with the balance attributable to continued business momentum driven by solid member growth and ad sales. And you can actually see right here at the bottom, they actually saw business momentum continue. In fact, Netflix members watched over 95 billion hours of Netflix in the first half of the year, which is a 1% increase year over year. Now, that's actually significant, especially when you look at how they tally that. It's that figure right there is almost like same store sales for Netflix. So to see a 1% increase is actually really, really good because people consume a lot of Netflix in aggregate. So, and that is also inclusive of the fact that the second half is going to be heavily loaded with content. Something else with regards to their guidance, I'll read this whole paragraph right here. It was very interesting, and it is in regards to their ads business. Netflix say, we continue to make progress building our ads business and still expect to roughly double ads revenue in 2025. A key focus this year is enhancing our capabilities for advertisers. We completed the rollout of the Netflix ad suite, something we spoke about in our previous Netflix video, Our in-house first-party ad tech platform to all of our ad markets and early results are in line with our expectations. We believe our ad tech platform is foundational to our long-term ad strategy. Over time, it will enable us to offer better measurement, enhanced targeting, innovative ad formats, and expanded programmatic capabilities. We also recently announced that we will integrate Yahoo DSP into our programmatic offering. So all in all, the ads business is firing on all cylinders. The business is firing on all cylinders. Consumers are consuming more Netflix than previous. But with the stellar earnings report, the stock is down 1.86%. I mean, this is a great report. Revenue grew, earnings per share grew, customer metrics are up. They raised guidance. They're expecting to double their ad revenue, an absolutely stellar quarter. Nothing to fault, but the stock was really down. And that really comes back to the valuation of the company. And it is pricey. Netflix is not cheap, trading at 42 times EV to EBIT. Now, this is last 12 months, 55 times on a PE. And I think on next 12-month PE, it's like 45 times as well. It's absolutely ridiculous. And Netflix has perpetually been in this state of, a very, very high valuation. So this is nothing new for Netflix, but it is still pricey with a shareholder yield of 1.18%. So where does this leave us with the valuation of the company? It's quite simple. Now, when you plug in the trailing 12-month revenue, right, and you grow at consensus of 11%, through 2029. So at that point, Netflix will be doing $70 billion of revenue, EBIT margins of 30%, growing to 33%. You see earnings before interest and tax of $23 billion. The current EV to EBIT multiple is 45. Now, what I did here was I tried to figure out a way to get a 10% return for Netflix over the next 5 years, a compounded annual return, right? And the multiple that you would need for that is 36, which is really, really pricey. So you can see a little bit of multiple contraction in Netflix from 45 to 36. But in any case, right, if you're looking at getting into a stock and the exit multiple you need is anything above like 25, that's probably not a good investment. And even then, the multiple can be at 45 and you could still get excellent returns from here in Netflix. But the most likely outcome is that if anything is to disrupt Netflix's business, let's say Netflix had a Google moment like what ChatGPT did to Google, you're going to see this multiple compress, and then you can actually see negative returns for a stock like Netflix. So to get 10% in Netflix, you have to grow at consensus, margins must expand, and 36 times EV to EBITDA. That is asking. And the icing on top of that cake is you need 1% sequential share decreases every single year. If you get that, you can maybe get a $2,000 Netflix share price in 2029. They currently trade at $1,274. That's a 10% return. My fair value is closer to $1,000. So if the stock is to pull back after this earnings over the next couple of weeks and we get to this 1,000 level, that would be fair value, I guess. But the multiple does seem a bit frothy. Looking at the technicals, right, this level right here, this is the 1,000 level. That is ultimately if Netflix is to pull back where you should find support. You could see that this section right here is that Liberation Day lows. We had a bit of consolidation right here. It's a high volume area, as you can see from these big volume nodes right here. So if Netflix is to pull back over the next couple of weeks, expect to find support here between $950 and $1,000. And if you do find support and we do see momentum that's about to turn to the upside, that's probably where you can buy Netflix for a short-term trade. But other than that, I would not be a buyer of Netflix at these highs. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.